Okay, this is the numbers from the problem that we looked at last time. You may have to pull that up to see the numbers, but I'm going to give most of it to you today. And that is that they paid, Paris, that is, paid for Santa. They paid 400 cash, 400,000 cash, and then they gave them stock in the form of a value of, I think it's $32 a share, and that came out to a total value of 320,000 as far as the value. So at $32,000 a share, they must have given them 10,000 shares. So they gave them 10,000 shares of Paris stock at a fair value of 32, and the par value was 30. Of course, this problem was where Paris buys Santa and then Santa dissolves, which means we don't have consolidated. But I'm going to approach this problem from the standpoint of why they have to both be the same. The concept of the consolidated is to show Paris as one company having bought the stock of Santa, but as if it's one company. And if Santa dissolves into Paris, it's the same thing, isn't it? Let me say that again. If Paris buys the stock and dissolves everything that it buys into Paris, okay, that's one thing. That's all the assets become part of Paris, and all the liabilities become part of Paris if it's dissolved inside. And then the subsequent balance sheet of that date of purchase represents all of the assets and liabilities combined into all the assets and liabilities of Paris. Okay, so far so good, I think. Let's go back to if Santa is purchased, but it not as a stock that's going to get dissolved, but where Santa will remain as a separate company. Then we go to Paris to perform a balance sheet at the date of acquisition. It's going to be a consolidated balance sheet, as we've learned. The consolidation is going to show as if all of these things belong to Paris. That's the idea of the consolidation. So that's why the numbers become the same in either case. What are we consolidating? The assets and the liabilities. The equity, we're not consolidating. We spoke about that in class, but we're not consolidating that in the sense that we're going to show Santa as a separate entity. We're showing Santa as if it belonged to Paris, similar to what we do when Santa is dissolved into Paris and Paris actually owns it. That's really what this is all about. Okay, so having said that, let's get some of the ink off of here. So that means that we have to just take a look at what we bought, how much did we pay, and figure out what all it means in terms of the values that would be shown on a statement of Paris. Whether it's Paris, I'm going to say it again, whether it's Paris with all the assets, liabilities of Santa merged into Paris, or Paris as a consolidated. And the consolidated is doing nothing more, that's a way to say it, the consolidated statement is doing nothing more than what Paris would do if they bought the assets and the liabilities, because that's what a consolidated statement means. Consolidated statement means we're going to show it as if they bought it. That may be a good way to look at it, as if they bought the assets and liabilities owned only by one company. Consolidated. Okay, so that will explain why the numbers will be the same on a acquisition date financial statement. Now, balance sheet, that is. Now, Chapter 3 will be going forward to the next day, so we'll worry about that later. Let's just stay with the flow. All right, so having said that, either way you look at it, when you go to figure out what is cash, you're going to combine the cash. You're going to combine the cash. Now, since there's no difference between the book value and the cash, it means the total book value will be the total of those two together. since there's no difference between the fair value of the receivables and the book value, it means we simply add those together. After all, if there is no difference, it means what we paid included this value. Let's do another color. Included this value and included this value. And what did we pay? Let's take a look at that. Let's go back to the facts. We paid $400 cash plus fair market value of stock. So that's a total of $720,000. You can do the math. You were supposed to try the problem on your own, so maybe you did. And you came up with the $720,000 number. 720. That's what they paid. One more time. They paid $720. Okay, so let's see what they paid for. Well, they paid for $140 cash. They paid for $280 accounts receivable. They paid for inventory, but the inventory they paid for was not just the book value amount. It included another $60 to get to the fair value amount. So they paid for $260 inventory. They paid for the fair value. The same with the plant assets. Plant assets, it turns out, has a, well then let's do the land. The land was next. The land was less than in value, so they didn't pay 100. Look, they didn't pay 150 for the land here, per the book value. They only paid 140. So you want to show the land at being 140. Plant assets net. What did they pay? They paid a total, or included in the total, what they bought was they paid $355 for the fair value. Yes, the book value is a different number, but they really bought this. They bought the $355. So we put the $355 here. Then they bought the construction permits, $170, but is on the books, but the real value is $190. The real value is $190. So they paid $190 in the construction permits. And then we come to the payables. They assumed payables at $140, same as on the books. They assumed other expenses at $45. And they assumed the notes payable at $460. Those numbers are all the same as they are on the books. They could have been different, but in this problem they're all the same. So let's see what we got. Let's do some math here. I'm going to take a calculator and I'm going to look at this number, and this number, and this number. You're getting the picture. I'm going to look at all these numbers and add them all together. I'm going to be subtracting these because these are the liabilities. And let's see what happens when I do it. You can try this at home. Maybe you will. And maybe I'll be wrong in what I'm doing. And then you can sit back and laugh. That's part of what's fun about this course. 190. Now I'm at 1. Take out the liabilities. And you should have a pretty good idea what number I should come up with. I should come up with, when I do all these numbers together, what should I come up with? If it's not clear to you what I should come up with, you got to sit back and review the video and look at these things from the big picture. I should come up with what I paid, a net of $720, which is exactly what I come up with. Check the math yourself. Go back and look at the actual numbers in the problem and see why that makes all the sense in the world. Now I can understand something. I can understand that if I paid $720 and all these things listed over here, represent everything I bought, including everything I assumed in liabilities, you should see now that I didn't pay more than the actual tangible identified assets and liabilities that are there. Let me say that one more time. I didn't pay anything more than the identified assets and liabilities that I purchased or assumed in this transaction. So since I didn't pay anything more, now I know one thing of importance. There is no no what? No goodwill in this purchase. The goodwill would have been add all this up here, like we just did, which is everything that we can identify of assets that are owned by the subsidiary, and then we find, let's say, just for an illustration, let's say we had paid $750, but everything adds up to a value of the net identified assets of $720, then goodwill would have been $30K, the difference. That's the only way we can explain why we pay more than the net identified assets at their fair values minus the liabilities that we assumed at their fair values. So now you get maybe a better idea or a different glimpse of what goodwill is all about and why the residual method that we've been doing in class works. That pretty much answers the problem, because if you bought, let's go back to the big picture. In fact, I'm going to take off the ink at this point. If you bought this, that's what you bought, it means that you didn't buy this. If you are paying for Santa, you're not paying for this stock. You're paying for what all this is. And what all this is your assets minus liabilities, which equals this number. But the fair value includes the differences in the detail of all the line items. So since it includes the detail of all the line items, in order to get to your purchase balance sheet after you've bought it, you're going to have to add or subtract the differences between the book value and the fair value. That's what you're going to have to do. Now, in the true answer to the problem, since this problem was the day before the acquisition, you are going to add cash. Just to give you the answer, you're going to add cash across, and then you're going to subtract the cash you paid. So you would subtract the $400,000 that you actually paid, plus you would subtract, I think it was $35,000 for the accounting fees and the $8,000 for the fees to record the stock or license the stock issuance costs. That would have come off. Then what you would have done is you would have started adding the accounts receivable across at the numbers that you see here. That would have been without change from the book value, because there was no difference between that and the book value. So that wasn't anything that caused any kinds of problems. And then you would have just done the normal moving across of everything of the assets and liabilities that you would expect it. No other tricks at this point as with cash. The goodwill we already know is zero. We would have shown additional common stock that Paris issued. So going over here, Paris issued common stock. The par value is $30. They issued an additional 10,000 shares. So for common stock, we would have shown at the par value, we would have added $300,000 to its common stock, because that was newly issued stock as part of the purchase price. Paid in capital would have been $20,000, representing the $2 difference between the fair value and the par value at 10,000 shares. So that would have been the paid in capital. And the retained earnings, normally, this is just a tricky, little slight trick part to this kind of problem, where they're showing you the balances prior to the purchase. So the retained earnings have to be reduced by the $35,000 of investment expense, because the $8,000 paid to the accountant is going to come off of the additional paid in capital. So that's why I wasn't quite finished with that. So here you're going to have this added together, then you're going to subtract the $8,000 paid in capital. I'll send out I think I could send out maybe a solution for you that you can use a little bit better to see the exact numbers in not a spreadsheet, but in and you can do this in a spreadsheet, and you should see that it comes out to the same way. So the retained earnings of the parent will change, because $35,000 is getting charged as an expense. the paid-in capital gets reduced, as we showed here. Hopefully what you're seeing with this, and then we'll sort of wrap it up, is you're seeing that the common stock equity of the subsidiary goes nowhere, either in the consolidation statement or when this company is dissolved into the parent.